Well, having a 10% correction is usually expected in the market, and it happens quite often. In fact, more than half of the corrections that we've seen in the market over the last 10 years have been just gentle 10% corrections. The question is going to be, right now it's holding. In fact, today was really looking a bit scary first thing in the morning, speaking of Tuesday morning, and of course the market has come back considerably from the lows. So it's going to be a matter of what the market wants to focus on. There are issues and then there are some positives. So it could go either way from here, but I'm thinking we're going to have a little bounce first, and then we'll see what the market is made of, especially if we can see buyers coming back into the tech space. And as the winter starts coming in, there's definite fears that we'll get a much more significant second wave of the virus than the sort of wave we had, or the gentle wave we had over the course of the summer. But that remains to be seen. Of course, the vaccine is still on the table. I think the bigger concerns right now hitting the market are really what's happening with China, which is something that you and I have talked about before. Also, some of the issues just in terms of how much more growth can the economy have at this point, considering that the stimulus money has sort of stopped. The loan moratorium in terms of repayments is about to expire, as well as some of the support that was happening for the people who are furloughed. So it's will they come out with another stimulus amount of money? We're in a political year, so I'd say probably the chances are yes. So there's a lot of reasons right now to be cautious in terms of the building of equity positions. Well, I think that's where some of the reflection of perhaps the economy peaked came in. We had a tremendous amount of summer driving. Just personally, I could tell you that we went to the Yellowstone National Park and the Grand Teton National Park, and it was packed. They were saying that 40,000 cars were coming through a day. So that's a lot of summer driving, but now we're heading into the fall. And so a lot of that demand for oil and gas is starting to dissipate. And then Saudi Arabia announced that they were going to reduce the prices, so that didn't help. And oil has been, I think, kind of dying on the vine anyway for quite some time. So we don't want to see it go down completely. Obviously, that would not be a good signal for the market and the demand. But on the other hand, if we could switch the mindset a little bit to more cleaner energy, that could be a positive. Even General Motors announced a deal with Nikola, which is an electric car company. I know China has been very, very active, particularly buying Teslas, although that stock has come off. It was running a bit rich. And the whole general idea in terms of switching more to fuel efficient or clean energy is picking up with the younger generations. Now, natural gas is something to keep an eye on as well. And then I also read over the weekend that China's looking back at nuclear in terms of nuclear energy as a clean energy place for them to go. So it's the world is changing. I mean, it's definitely changing. It's kind of exciting in a sense. Maybe a little nerve-wracking if you're heavily long tech stocks, but you got to keep up. You know, there's no sitting around anymore, buy, hold passively. That's gone. Actually, I was quite grateful to gold because it peaked right before I left. We took some profit. Then it dumped while I was gone. And now over the last week since I've been back, it found support right at a major moving average, the 50-day moving average. I'm still very, very bullish in gold, and I think that today might have been the best buy opportunity. Might give it one more day to see how it sits here and if it holds these levels. That goes for gold miners, by the way, and silver as well. And the gold miners are really interesting to me right here because they had this correction and then all of a sudden a bunch of buying came in over the last few days. I think what's really happening with China is very interesting and supports the gold thesis. Well, they're reducing their exposure to the US dollar for one. The digital yuan is now being looked at not only as a competition to the dollar, but that world reserve currency could possibly happen, which is something that I was scoffed at when I mentioned a few times over the last year. And the reason why they're reducing their exposures not only to the dollar, but also to the US bonds, they're the second largest bond holder, and they're reducing their exposure from $1 trillion to $800 billion and possibly more, is because even China's starting to worry about inflation in the United States, given what's happened to the dollar. That would be Not very good for the United States, but definitely good for gold.